Hi guys, I'm going to do a video about technology stocks. So you've probably heard of the popular acronym FANG before. So a lot of people call them FANG stocks. Um, so the most well-known tech stocks would probably be FANG. So what does FANG stand for? There's Facebook. Sorry, my pen's not working today. Facebook. There's Apple. You can also use the A for Amazon. N is Netflix. Google is G. So 5 to 10 years ago, the term FANG was very popular. So that covered these 1, 2, 3, 4, 5 different stocks. Now I think more popular is probably Mag 7. Mag 7 stocks or Magnificent 7 stocks. I believe this term is used more often now, and FANG is probably not as popular. So Magnificent 7 is basically these 5 with the addition of NVIDIA. And the last one would be Tesla. So we have NVIDIA, Tesla, Facebook, Apple, Amazon, Netflix, and Google. Let's count them. 1, 2, 3, 4, 5, 6, 7. Okay, so the Magnificent 7 or the Mag 7 stocks, I think, is the more popular term nowadays. So what about them? Well, I do own, again, this is not financial advice, so do your own research before you put any money into any single stocks, but especially tech stocks can be a little bit more volatile. I personally do own all of these stocks. Most recently, NVIDIA and Tesla are pretty new to me, but definitely these FANG stocks I've had since probably 2015, I think. 2015, 2016 is when I first started buying single stocks anyways. The very first stock I ever bought, I actually forget the name, but it was some type of oil stock that I probably shouldn't have bought as my first stock ever. I only kept the oil stock for maybe 1 or 2 weeks. It suddenly dropped in price. I got scared and I sold it off. So I actually lost money on my first stock, which was an oil stock. Second stock I ever bought was not on this list. It's not a tech stock. It was actually Berkshire Hathaway. So Berkshire Hathaway, you can think of, it's kind of thought of as a kind of conglomerate or holding company. It also owns multiple stocks in the company itself. So a lot of people actually consider Berkshire Hathaway kind of like a mutual fund versus a stock. just because it owns multiple companies. So theoretically, it should be, you know, somewhat of a diversified single stock to buy because it has ownership in multiple companies. Anyways, that was my second stock I've ever bought. The third stock I ever bought was Apple. So to date, I feel like Apple is probably the best performing single stock I've ever bought. Well, single stock or ETF. I believe the best share of Apple, performing share of Apple I have is up, I think, 600 to 700%. I mean, overall, all my shares of Apple are maybe, uh, overall, all my shares of Apple, I think about 250, up 250%. But, you know, the best performing shares are up about 5 to 600%, I believe. So definitely Apple, I feel like, is my best performing single stock. Again, this is not financial advice, so do your own research before you put any money into, you know, single stocks, tech stocks, or, you know, ETF or even mutual funds. Know what you're investing in. Facebook, I've had for a while too. Facebook has been very volatile. So if you're lucky enough to kind of buy shares during the big downs, you've probably, you know, made some money off Facebook. They actually changed their name to, I believe nowadays it's actually called Meta instead of Facebook. I think supposedly that was kind of maybe the direction they're heading in, or might have been just a distraction because they're having some political, I think some political issues at the time, but we won't get into that. Amazon, Amazon obviously a super successful company. My Amazon's doing pretty well. So Amazon's PE, or price to earnings ratio, is pretty high, even compared to other tech stocks. So in general, unless you got in early with Amazon, you could consider it a little bit overvalued stock. Netflix, my Netflix is doing pretty good right now, actually. There was a time that my shares in Netflix, anyways, I didn't buy in too early. I think I started buying shares back in 2016, 2017. Even those initial shares did crash pretty hard. And just recently, I would say, past year or so, it seems to be recovering. Google, Google has done pretty well for me as well. Google is a little bit, has a lower, what they call price to earning PE ratio, or price to earnings ratio. So the PE can tell you, you know, you can compare different stocks based on PE. And Google's PE is a little bit lower. So the higher a company's PE is, it's usually considered possibly a little bit overvalued. But the higher the PE, you can also gauge the stock that it has more potential for growth. So definitely Amazon has a high PE, high potential for growth. These are both tech stocks, but I believe the PE ratio for Google is a little bit lower. So I feel like it's kind of a better buy. My Google has done a little bit better than Amazon, and I believe I bought shares of both of these around the same time. I have to admit, these two, uh, the two other stocks, Nvidia and Tesla, are rather new to me. I did not buy any Tesla until after the most recent stock split. Overall, I believe my Tesla shares are up about 60%, so they're doing okay, but I was kind of late into the game. I wasn't a big believer in Tesla until it entered the S&P 500 and actually was revenue positive, because I felt like it was just kind of a money losing company in the beginning. And I was not, I know it's blasphemy, but I was not a big believer in Elon Musk. And Nvidia, I actually bought Nvidia back, I believe, right after COVID hit, so 2020. I only kept it for a year or two because the price was, I felt like the price was dropping forever, and I got scared and I sold it. Then only recently I rebought into it. I believe I bought Nvidia right after their most recent stock split as well. So it's a little bit cheaper per share. But even though I've only held it, I think less than a year, it's actually doing pretty well. But we'll see long term what it does. If you look at the stock price or the stock chart or the graph for Nvidia, it's kind of parabolic already, so you have to be a little careful. If you look at any stock based on a chart, um, if it looks like it's doing too well or it's going parabolic, it probably means you have to be a little careful, as no stock can go up forever and eventually has to come down. So once it's parabolic, I feel like it's pretty high risk to start tanking or going down in price, and it may go down a lot. So just be careful. So you don't want to lose too much money if you kind of buy at the peak of a parabolic stock climbing. Tesla is kind of going parabolic as well. I don't want to get too political, but it started going crazy after Elon Musk, I guess, started becoming buddy-buddy with President Trump. But again, I won't get into that, other than the stock price is doing pretty well the past, I don't know, 3 or 4 weeks since the election results. And as usual, Elon Musk started, I don't know, tweeting or making public statements. Okay, anyways, I won't talk about that. So back to these. These are the Magnificent Seven. They're all considered tech stocks. They're all very famous technology stocks. So most of these, well, all of these, I believe, are considered, will be large cap growth stocks. If we look at these, I think most finance professionals or pundits or even Yahoo Finance will consider all these 7 stocks to be tech stocks. Technically, I believe Apple considers themselves to actually be consumer discretionary. I'm not sure. So that might be a little bit debatable. And then Tesla, obviously, the argument, is it a tech company or is it a car company? But with Musk at the helm, I think it's being viewed more as an innovative tech company versus car company, or that I feel like that's how it's valued, because most car company stocks kind of suck. So they're definitely not doing as well as Tesla. Okay, so yeah, so all these I would say are considered large cap growth stocks. So growth is kind of the opposite end of the spectrum as value. I mean, large cap being that these are all large companies over 10 billion in market cap, I believe. Growth, meaning there's a lot of potential for growth. The opposite is value, meaning the company's been around a long time. Most value stocks are also can be considered dividend stocks or kick out at least some dividend. Dividend is basically, if a company is making money, it will try to reward the shareholders by giving a percentage of their profits to the shareholders via dividends. So large cap value, more often than not, does have dividends, whereas large cap growth stocks or growth stocks in general tend to not have any dividends or have very low dividends for growth stocks because they reinvest the profit back into the company to try to make it grow versus giving it back to shareholders. Sorry, let me take a quick drink of water. Yeah, so what does that mean? It means that, single stocks in general are pretty high risk. So I would recommend that if you're a new investor, you stick with ETFs or mutual funds, much more diversified. If you look at S&P 500 ETF has 500 stocks, total market ETF has 4,000 stocks. So unlikely that you're going to lose a lot of your money or all your money if the stock market tanks, because there are so many different companies that the risk is spread out. Whereas if you buy a single stock like one of these, if horrible headlines hits Facebook again or Meta, there's a chance you can, I believe the stock price did drop like down to 50%. Excuse me, a couple years ago. So definitely more risk with a single stock, and risk in general is kind of relative. It depends what you're comparing it to. So say if you're comparing a large cap stock to a small cap stock, then, or let's say you take one of these large cap growth stocks and compare it to a small cap stock, even though tech stocks are considered a little bit risky compared to small cap stock, maybe it is not risky because definitely a smaller company or small cap stock is going to be more risky compared to a well-established large cap stock. And then for another example, if you want to compare a large cap value stock versus a large cap growth stock, the value stock will probably be considered less risky because large cap value stocks tend to be, bigger company, they've been around longer, they're making profit, and that's why they're taking part of that profit and giving it back to the shareholders as dividends. So in general, those large cap value stocks or companies tend to be less risky because they're more well established. And then I kind of mentioned earlier, if you're buying single stocks, one of the parameters you can look at is the PE ratio or price to earnings ratio. So again, it's kind of debatable. Read books about it, then you can form your own opinion. But usually a PE ratio of less than 20, excuse me, is considered, cheap or a pretty good buy. Anything 20 to 30, in between 20 to 30 PE ratio is considered probably kind of borderline or questionable, meaning they're not super cheap. And then anything probably greater than 30 as a PE ratio is considered possibly overvalued. And most big name tech stocks like these are going to be probably over 30. I mean, it depends what the market's doing. During a crash, then obviously all of these might even be below 30. like a market crash. So like say, um, in 2020, I'm sure all of these were probably cheap while the market was crashing. So kind of depends on the market situation, I guess. So again, single stocks, I would not recommend them for beginners. Stick with ETFs or mutual funds. Do your research and learn a little bit more about investing before you plunge into single stocks and lose all your money. I mean, honestly, I think all these are good buys. I don't think you're going to lose a lot of money investing these if you're a long-term investor, meaning you're going to keep it more than 1 or 2 years. Ideally, you want to keep any stock for more than 5 years to get a good return on it. But with anything, you have to kind of have the stomach to hang in there. If you're going to invest in single stocks, you don't want to end up selling at the bottom of a market crash because you get scared. So if you buy high and you sell low when the stock market is in a bloodbath, then obviously it's possible to lose a lot of money. So stick with ETFs or mutual funds. And when you do kind of start investing in single stocks, I would say do it in small amounts. Maybe just buy one share at a time, or throw in a few $100 and play around with it and start learning. Don't throw $1 million in there and let it ride. Excuse me, sorry guys. Okay, what else? Oh, so another thing I noticed, if you take a S&P 500 fund or ETF, if you look at the top 5 to 10 holdings, they're probably going to be these large cap tech stocks. So that should also tell you it's probably, pretty safe and probably pretty popular investment. What I've been doing with my portfolio, again, do your own research, but I've been investing for about 10 years now. Taught myself by reading a lot of investing books. My self-directed portfolio, I'm up about $120,000, but that's over 10 years, so keep that in mind. My 401k portfolio, I would guess, haven't calculated it for sure, but I would guess it's probably around 50,000, or I'm up 50,000. So both the 401k and my self-directed portfolio, all this is passive income. So definitely, I would say if you want to increase your wealth, learn more about investing, read books, especially if you're looking to retire early. I think stock investing is a good way to do that. But the more knowledge you have, the more you can mitigate your risk and not lose money. So what I've been doing is I have the majority of my invested money in like an ETF, diversified ETF. So I'll admit, most of my money is in VTI. That might not be the greatest choice for you, but I believe VTI is super safe. And then I have a little bit of money in these single stock tech stocks. Sorry, I think the monitor went off there. There we go. Yeah, so most of my money is in VTI, and then I have a little bit in single stocks to play around with. Don't invest any money in the stock market that you can't afford to lose. I believe if you have some knowledge and you pick judiciously, you're probably not gonna, and you hold long term, you're probably not gonna really lose any money if you know what you're doing in the stock market. So I would, if you want to follow my blueprint, most of my money is in a safe diversified ETF such as VTI. Play around a little bit of, you can allocate whatever you think, maybe 5%, 10% of your portfolio in single tech stocks if you have the money to do that, and if you have the risk appetite that you're okay losing some money if the market does bad. But I feel like if you don't sell, you just hold even during a crash, in a year or so, it's probably going to recover, or at least it always has, so far for the U.S. stock market. As long as we're talking about, large cap stocks or things like this, things like these 7 stocks that are pretty reliable, large brand. So it's not like you're buying IPOs or small cap companies, which I have done, and pretty much all my IPOs have tanked. I've lost money on all of my IPOs except for maybe Uber is the only one that I think that's net positive right now. Okay, so I know a lot of stuff to digest that we just covered. I'm going to do some other videos, some individual videos on each of these stocks to give a little bit more detailed information, but this is pretty much just the big overview. Okay, so tech stocks, FANG stocks, Magnificent 7. Okay, later guys.